we're in a very, very interesting market. We basically we plummeted, as open range would suggest we should have. We came down and tagged that 77% Fibonacci, as well as that trend line right on the nub, and rallied straight off of it. So you can see we've had what would seem to be a very significant short covering rally, and as Stratha always says, the shorts, the rallies in a bear market are always much more magnificent than in the bull market, and you can see, like, we just had a big jump here today on good volume, a lot of it from short covering, and as we tag up. Now, I don't think we're going to go much higher than the 2100 level. We may kind of have a little kind of an evening star where we close basically in the middle of the range. The market makers are going to want to try and hold it between 2090 and 2100 until the end of the week. We'll see how successful they are in doing that. But that's basically what we want to watch. Maybe an up candle into the into that resistance level, then a bit of a rollover, a bounce down, a candle up, a candle down. That gives us 1, 2, 3, 4 candles, and that basically takes us into next week. Of course, that also, so basically looking for 3 more candles in this range. So 1, 2, 3. So by the end of the week, I'm looking to close, I think we're going to close somewhere between 2090 and 2095 on the S&P 500. Now, that will then lead into open range for Monday, which will be somewhere close to that. And then what we're looking there from Tuesday is for it to then close below that range and continue its downward descent. So that's basically kind of the way that we're looking at this if this market continues to be bearish, as we expect it should be. Now, one thing we have, Strath and I have talked a lot about all of last night and for the last few weeks. We've been talking about obviously the impending problems with the global economy. Now, Strath and I have we spent most of the weekend researching. Well, I'll show you what we've been looking at where the market's going to go to next, and then we feel that there's a potentially huge problem that we may be on the brink of now, or we're starting to see it now. We've talked about the huge insider selling. We've seen the massive gap downs, and we're going to talk about some of the key points that we feel that this market is building towards. Now, just to give you a forewarning, this is very fundamentally based. So, I mean, if you feel that it's a bit beyond kind of your knowledge and so forth, don't worry. This is just to set the context of why the market is forming up like this. What we're going to talk about is a special class we're going to be doing next Tuesday night after Trading Room that is going to be focused on these topics that we're about to discuss. But what I'll do is I'm just going to bring up the issues. The main problems that Strath and I have talked about over these last couple of weeks and specifically over these last few days are these key points. What's happening right now is obviously we have a major contraction in price levels of oil and natural resources, and what that leads to is bankruptcies. So we look at oil explorers, oil servicing companies. As we start to see these companies go belly up, that's going to create bankruptcies. Bankruptcies create a contraction in credit supply as those underwriting those loans start to tighten up the chains. They start to tighten up the chains. What else happens? Well, all of the loans they're giving out, like subprime to automotive companies, things like that, that goes away. Consumers start spending less money. Consumer goods start to drop. And as all of this starts to occur, the market falls. We see a credit crunch like we saw in 2008, if not worse. What then happens? Well, everyone betting on the long side of the market, as we talked about last week when we talked about the huge divergence in the high-yield corporate bonds versus the market since 2012, that suddenly starts to trend back towards each other. And we see that in the estimated derivatives market, which represents an estimated level of $600 trillion of bubble. And when that pops, that then in turn brings things down, like we saw with AIG. P/E ratios then collapse because money starts seeking safety. We talked about the TLT, the Treasury bonds last week. That's been rallying. So money is seeking safety. So the P/E ratios, earnings don't change, but people are no longer willing to pay the multiples that are representative of the risk associated with the market right now. Therefore, more investors sell. ETFs start to plunge, and along with that, the market. And then to tie that on, you start to think about things like Greece and the European sovereign debt. And as the market starts to fold in on itself, problems like sovereign debt and Greece start to rear their ugly head again. People start to doubt the validity of money that can never be paid back. And that's the problem that we need to see solved, and the solution is a long way away. We've been kicking the can along since 2010, if not earlier, and the problem is that it hasn't changed, it hasn't gone away, and we need to see some kind of natural leveling out of the markets without this constant quantitative easing. The debt levels have only continued to increase in the global economies. China has contracted, and as Strath would say, outright stopped any kind of growth, and to the point of them, banning the people with all the money selling any of their shares. So there's no liquidity for the rich. Money's going out of the country, the nation. And any companies that are set to drop, they don't let them by delisting them from trading for a temporary period. So we've got an unnatural market coming from the place that represents 70% of the demand of natural resources around the world. So we're dealing with some serious issues, and of course the fun is always the funnest until it ends. And then you got to deal with the consequences, and that's what we feel is right around the corner. We're already seeing the core factors of the market collapse. So this is a very special situation where yes, the technicals are very important, but this is where we start to have opportunities where, well, I mean, as Strath would say, you said to me last night, Strath, he said, I've been in these markets now for over 50 years. I've never seen an opportunity this great or this perfectly set up for things to crash. Strath, now I'll pass the commentary to you for a moment.
Yeah, all of these things have been setting up. None of the real problems that have affected the world economies have been resolved. In 2008, the U.S. national debt was $8 trillion. Here we are, 6 years later, it's now at $19 trillion. So governments don't have the ammunition to stave this off. Quantitative easing has been a failure as far as economic growth has been concerned on a worldwide basis. We've had all of this liquidity poured into the market, and all it's done is create bubbles. First of all, in the bond market, yields have been driven down, prices have been bid up by central banks, monetizing debt, and so that has got to be resolved. Worldwide debt has increased by 45 to 50% since 2008, 2009. And when we come to a situation, let's take Greece for existence, or for instance, people say, oh, well, the little Greece economy doesn't have any impact on the world economy. That's not the issue in Greece. They happen to owe $360 billion, and somebody's going to have to eat that. And the remedy that the European lenders are handing off to Greece is something that the Greek government just can't put into place. You'll have a revolt in the streets. So that situation is going to get worse. In Asia, there are serious problems developing in countries that most of their exports are to China. We have Malaysia, Indonesia, and Thailand. All of those countries, their currencies are under terrific pressure, and they have a lot of their debt is in U.S. Dollar terms. So the U.S. dollar rises and their currencies decline. That puts them in a much worse position. Now, when the European currency crisis erupted in 1997 and 1998, the first currency to go was the Thailand baht, and that one is the one that's leading the way down now. Indonesia is second. The rupiah is collapsing. So the problems in China, you know, China may sort them out. They're not going to spend any of their foreign exchange reserves. They'll just print yuan or renminbi, whatever you want to call them, to shore up the stock market or whatever they feel is necessary. I don't think they can prevent a further decline in the market, but it doesn't make any difference as far as we're concerned. Now, the next thing is going to be Brazil. The Brazilian real is falling apart. Brazil is heavily dependent on the export of commodities, oil and copper and iron ore. And if you look at their leading companies, Vale and the Brazilian oil company, those companies are next to broke. So what's going to happen here as some of these factors begin to manifest themselves? Companies are going to go into survival mode. They're not going to be spending money on plant and equipment, anything like that. They'll be just trying to survive. So this will probably lead to a further contraction in the market. Now, in Canada, I was reading an article last week. In Toronto, there are presently 193 condominium towers being built. All of these units are huge. They're anywhere from 12 to 1,800 units in each one of these buildings. That's over 300,000 units that'll be coming onto the market during the next year. There are a lot of people who believe that that market could have a severe correction to the downside. It's happened before, and it could very well happen again. And the province of Ontario is digging itself into a deeper hole by spending money trying to create jobs in the economy by offering corporations big tax advantages and paying part of the cost of developing new green technologies. And that could become a problem in Canada if the province of Ontario needs a bailout from the federal government. How is that going to work? These are all things that we're going to be monitoring on a month-to-month basis, and so I'll hand it back to you, John. These are some of the issues that the market is facing, and everybody's so complacent that it just scares the hell out of me. If price earnings multiples contract to, say, 15 times earnings from the present 18, that represents a 20% drop in the market without taking into consideration any decline in earnings. If it were to drop to 12 times earnings, and you must remember that in 1982, the Dow Jones was selling at 6 times earnings. So it can get there. So if the multiples decline to 12 times earnings, that would be a 33.33% drop in this market. You can imagine what that would do. That would take about 600 points off of the S&P, and I just want to know how many people would like to go through that kind of a decline if they're long the market.
If they're
Anyway,
long the market, exactly. Yeah, no, absolutely. So, I mean, and so look, so we hate to, well, no, not really, but I mean, to start things off, this is going to be a special event next week. Obviously, we will be covering the highlights through Trading Room as we always do. But for those of you who want to get really into this, I mean, this is a big. This is the way we see it. This is a massive potential money maker opportunity. We're talking like 5 times, 10 times potential returns with the appropriate strategy. So this is really kind of an initiative that Strath is heading, because it's where Strath's really best at. I mean, he called the market short June 6, 2008. So this is going down, and this is the only other time in my history of knowing Strath that he's been so vehement that I buy him a bottle of wine. So anyway, this is the course. It's next week. It's Tuesday. It's a one-time only course. It's a Tuesday, 4th of August, 5:30 Pacific. We've basically put everything together that is how Strath figured this out, how we are approaching the next 6 months. So it's not, we're not talking about 6-day trades. We're talking about, you know, positioning ourselves for positions we can hold for 4, 5, 6 months, where we're looking at, you know, high 3-digit potential returns. That's basically what we're looking for through utilizing short positions, but also a focus on how to go about buying puts and what strike prices we're looking at and what expiration dates we're looking at and why. And basically we've broken down through all of those events that we're just talking about, how do we turn that into a trade? What stocks fall into those categories, and what are their key weaknesses? So there's 20 stocks on the list, and we'll go through how we found them, so how we scan for them, so you can do this yourself. So it's not just this time, but you can use this going on, but why we feel they'll plummet and how to profit from them, how we're going to go about these positions. We do feel this is going to be the next 2008, and this will hopefully be the next big flag in Acorn's Corner where we can show people how good we are. So what's going to happen is the next Tuesday at 5:30, we are going to go through all those stocks, go through all the reasons why. We're going to be going through the scan. We're going to be going through the breakdown of each of the individual companies and technically the reasons behind them as well. And what's then going to happen is we're going to also hold monthly update classes in August, September, and October. So 3 classes going forward to update these more macroeconomic factors and obviously go through these 20 stocks that we're focusing on. This should be a big stable point in everyone's trading career, we hope. So if that's something that you're interested in, especially those who like to take some longer-term positions, it's the only time we've ever done this. For those of you who've been with us for a while will know that, and something we feel is very, very worthwhile. So we'll repeat the link. I mean, by the way, just to give you an idea of the value of this, one of the stocks that was on the list last night that Strath and I talked exacerbly about was AKAM, Akamai Technologies. This is one of the ones on the list, one of the 20. And this was a one highlighted for a $69 put. And this one reported after market today, coming out of a head and shoulders pattern. And last time I looked, it was down at $66 and change. I think it's $66.35.
$65.75 now.
What is it now?
$65.75.
$65.75. Okay, so I mean, if you had to put $1,000 into that, you probably will come out with 5 or 6. So those are the types. What we're looking at here is not just how to make 10-15%, but how over the next 6 months can we make 5-10 times our money, because these opportunities don't come around all the time. It seems, we don't obviously want the market to collapse, but it looks like it will, so why not make a lot of money in the meantime? Anyway, so there it is. I'll leave the link down the bottom, and we'll continue on with the session tonight. But guys and girls, money well spent.